All right, well, welcome to the Retire Ready podcast. I'm David Nicholas. I'm here with Graham Reynolds, one of our financial advisors at the firm, who is, I know you can't see this if you're listening to us, but he is rocking an amazing mustache. I'm going to come back to that mustache here in a second, but we appreciate you all tuning in for another episode of Retire Ready. It's our podcast now. I forget what episode we're on. I think we're beyond 5, which is hopefully a good thing. Our goal is to try to get these out to you as many times as we can. But today, we got a lot to cover. We're going to be talking a little bit about risk reward because the markets have really changed. If you look at where interest rates are today, it's pretty incredible what some of the rates are that you can get on CDs, on bonds, on fixed income. So we're going to talk a little bit about that. But before we do that, Graham, I want to spend some time on this mustache for a second.
I'm really glad you started there, David.
Let me ask you. So I don't think I could pull off this mustache. For those of you that are, if you go to our YouTube channel, you can see the video of this, and you can. I hope the camera's zooming in on his mustache right about now. Let me just say, what is your family? What does your mom think about the mustache? Is she a big fan?
She is not a fan at all.
She's
not allowed to see this episode. Please don't share it with her.
Okay.
If there are any friends of my mother out there.
I do feel like the mustache is kind of in style now, isn't it?
Coming back a little bit.
Okay.
I think it took a hiatus for a good while, but I'm seeing more mustaches out and about.
There you go.
So,
all right.
Yeah.
Well, it looks good.
Thanks.
Looks good.
Yeah.
Well, let's.
It's an honor to be on the show.
Yeah, I'm glad you're here. I'm glad you and your mustache are here on the
Yes,
show with us today,
both.
Graham Reynolds.
Absolutely.
Well, to talk about less exciting stuff, I want to talk about risk reward because, and I wanted Graham on for this show because Graham, obviously, you're one of our financial advisors here at the firm. One of the things that is interesting is just to see how the rate environment has changed. If you think about where rates were a year and a half ago, I mean, the average 1-year CD rate was under 1%. And so where did investors go to get risk? They had to go out and get equities to get any chance of return. Well, fast forward to today, average CD rate is well over 5%. So in a year and a half, we've had this massive move up in interest rates. And I think this just really comes down to, well, how does that change our planning? And Graham, this is something as a financial advisor, and it's for our listeners who are thinking about, well, what should I be doing? Should I be taking advantage of fixed income? Should I stay at risk in the market? So, Graham, we can probably just talk through that a little bit, but how have you seen your planning change just in the last year?
Yeah, no, I think it's a great starting place, David. We've talked about TINA. There is no alternative. Now there are lots of alternatives.
That's right.
And so competition, there's just a lot more competition for investments, and we don't have to go only to equities to get a higher rate of return over time. We're able to get 4 to 8% on our income bucket, 5% in a CD, money market. So there's lots more competition, but I think competition makes our investments stronger, just like it makes us stronger as humans. But the equity space is much more has much more competition than it has in the last decade plus. Yeah.
So talk about TINA for a second. Can you walk us through, I know you mentioned it, but what is TINA and what was that, what did TINA have to do with the markets of the last few years?
Yeah, our friend TINA. So we need to come up with a different acronym. There are many alternatives.
Now there are, yeah.
Yeah, what that acronym is. But yeah, TINA, there is no alternative. So when rates were so low for the longest time, you're going back a decade, so a year and a half ago, like you were saying, and then you
go back 20 years.
Less recent than that. We had to go to equities to get a higher rate of return because the risk-free rate was so low. And we've seen with the Federal Reserve having to hike interest rates quite significantly to combat inflation. We've seen that trickle through to savings accounts, high yield savings accounts, CDs, treasuries. I mean, the bond ETF, for example, taking advantage of those yields because we're able to get more juice for the squeeze.
Well, I'm looking at a chart here. The federal funds rate, so this is pre-COVID. So the federal funds rate is the rate that the Federal Reserve sets for banks to lend to other banks, what they call their overnight rate. And so pre-COVID, that was at 2.39% pre-COVID. During COVID, the Federal Reserve dropped the Fed funds rate down to I'm showing you got down to 0.07. April of 2021, not that long ago. April of 2021.
A lot's changed.
0.07. 7.
Yeah.
Okay. Where's the federal funds rate today? Federal funds rate is sitting at right at about 5.25. Okay. Just under 5.25. So 0.07 to 5.25. And this is this massive move higher that we've seen in rates. But you'd have to go all the way back to really November of 2006, or right before the housing bubble and bust, ultimately in '08. Fed funds rate got up to a little over 5, close to 5.5%. Before that, you'd have to go back to December of 2000. Fed funds rate was actually at 6.5%. But if you just look at we're at, what is that? It's got to be almost 20-year highs for the federal funds rate for interest rates, and so that's dramatically changed the landscape.
Yeah, on my ride in this morning, CNBC was talking about Treasury yields, the 10-year yield being at levels that we haven't seen since right before the great financial crisis.
That's right.
In '07.
Yeah.
So, I mean, the game has changed completely in the investment landscape.
And as of this recording, obviously it's going to change daily. 10-year rate was hovering around 4.3%, which, like you said, it's the highest level that the 10-year has been at in close to 17 years. And so here's, I think, a question. So if we're considering adding more fixed income to our portfolio, and fixed income are things like bonds, CDs, treasuries, this is the question I kind of want to ask you is, as an investor, do I go for a 10-year rate at 4.2%, or do I stay with, if I look at where short-term rates are? I mean, I know rates right now for bond. Let me pull up our yield curve here to see where rates are as of this recording. But if you look at where short-term, so 10 years sitting at 4.3, if I look at a 1 year sitting at about 5.4, or a 6 month sitting at 5.5%. So as an investor, do I take the 5.5% today, or do I try to go out and get the 4.3% and lock it in for 10 years? I mean, when you're looking at that, what are you analyzing when you're trying to make that choice?
I mean, a lot of different factors would go into a decision like that. I mean, I think you can make the case either way is the crazy thing. And there are lots of good arguments in each camp.
Yep.
And the bond market has been at odds with the stock market all year long. And the market's actually done quite well. But, for our clients, most of our clients who are close to or in retirement, we just don't need to go into the market to take on a ton of risk necessarily. So the fact that we can have a 10-year at 4.3 or a 2-year at 5.2, and then they fluctuate, like you said, but the fact that we even have that as an option is quite nice.
So when you're building a retirement plan for a client, obviously we've got our 3 main buckets. We've got our liquid bucket, we've got our income bucket, and we've got our growth bucket. Our growth bucket is predominantly equities. That's the growth part of the portfolio. It's there to keep up with inflation. Your income bucket is your fixed income bucket. So when are you staying on the short end of the curve, or are you going out to more 10 years to lock in some of those rates right now, at least on the fixed income piece of the
on the fixed income piece, looking out farther?
You're going out, you're locking in.
Absolutely.
Okay.
Absolutely. And the thing is, we have flexibility too. We can do both.
Sure.
Depending on the vehicle, but
so
absolutely.
Why do you like the longer end then at this point?
Let's take advantage of rates that we haven't seen in, we were saying, 17 years.
Yeah.
I mean, the boomers, their generation, and those older, but in that phase, they've craved these yields for the longest time. Haven't been able to get them.
Heck, I've craved these yields. I'm not a boomer, but I love it. No, I know.
Yeah, I know. So while we can take advantage of that, and we've woken up here, and rates are where they are, let's capitalize.
Yeah. That. So, okay, but what's the risk? Obviously, if we go out longer term, the risk is that rates go higher. So, okay, well, if rates go higher than they are now, and I guess that's always the risk, right? So I guess what drives long-term interest rates? It's really growth and inflation. And so I think the interesting thing is, if you think inflation is going higher, you want to stay on the short end of the curve. So the Treasury ETF that we launched, with the ticker symbols FIX, it's a lot shorter. The average maturity of our bonds are 6 months or less. So it's a short-term bond fund. But if you think rates are going down, you want to go long-term. You want to go 10 years. You want to potentially go even longer than that, which is for our retiree clients. I agree with you. We're locking in longer term rates. So, but what's the argument for longer term rates? If we think inflation is coming down, if you just look what's happening coming out of China, China's actually seeing deflation. China saw their CPI numbers go down. They're seeing retail sales go down. I mean, real estate market is just getting hit hard. So you kind of have to look at it. If China is dealing with deflation, I just saw numbers coming out of Europe. Similar story. Europe's dealing with deflation. The U.S. we're still dealing with inflation. And so I think the verdict is out, but I think we can all agree that the rate of inflation's growth is slowing.
Absolutely.
It's not saying that prices may not still go higher a little bit, but the rate at which inflation is growing, I think has certainly come down.
Mm-hmm. No, it is. And I think this morning, core. So if you exclude housing, CPI comes in at, I think, 2%. If you take out housing. Now, obviously, housing is a big piece of the CPI, but we have been getting encouraging data back from these prints, and there's some conflicting data depending on what you're looking at and the degree at which inflation is coming down. And there's been talk of the last, if you compare it to moving a football down the field. We're in the red zone now, trying to punch it in over the goal line to the Fed's goal of 2%. Those yards in that area of the field are the toughest to come by. And so those who say not so fast, it's going to be tough sledding to get to that 2% from here, now that we're in the 3 to 4 range. There's a good case for that.
So it's interesting. I just looked up when you were talking. So this is what I think you're talking about, the 3-month and 6-month trend. So a lot of times we look at the 1 year, but if you just look at the 3-month CPI trend, it's 1.9% annual rate. This right here is if you take out, so shelter costs as part of CPI is a 30% weight. So you're right, it's a pretty big weight in the CPI, but it uses data that's lagged 8 to 12 months. So if current data were used, like if we caught up and say we weren't using what rents were 8 months ago or housing costs 12 months ago, but if you go on based on current housing costs, CPI would already be well under 2%. So I think this goes to your argument is you might as well try to lock in some of this long-term fixed income. It could go higher, right? Inflation could go slightly higher, but the writing seems to be somewhat on the wall that inflation is starting to normalize.
It is, and our eyes are on Friday and Chairman Powell speaking at Jackson Hole too, and the folks who are in the camp of inflation is coming down. We've hiked as much as we have, and it's working. Let's not get too carried away here. Are hoping he doesn't come out and use the same verbiage of we're going to stay hawkish. It's still not enough, because what's been mentioned the last week or two, as far as the bond market going parabolic potentially, depending on what Powell comes out and says,
rates could skyrocket.
Exactly, and that's the last thing I think anybody wants to see.
So the Fed does not. The Fed is essentially saying no recession. They want a soft landing. If you listen to Jerome Powell's language, it's, hey, we've managed to bring prices down without any significant jump in unemployment rate. The unemployment rate has stayed 3.5% or lower, which is essentially full employment. So Jerome Powell right now is trying to make a case that they have engineered a soft landing. So the Fed's base case is no recession and unemployment stays low and you bring inflation down. I mean, if the Fed were to pull this off, it would be the greatest Federal Reserve policy move in human history.
The trifecta.
My faith in the Federal Reserve is not exactly
at all-time highs.
Yeah, my faith is not exactly that the Fed can pull this off, because something has to change in that either fuel prices start to head higher. So if fuel prices head higher, that goes right to the bottom line of CPI. If the Fed doesn't keep rates low, what's going to happen is you might have more Americans just wanting to rent versus buy a home, so that keeps rent prices stickier or trending back higher. I think the only way to sustainably get inflation down below that 2% level is to have the unemployment rate go up. We don't wish for it. We don't hope for it. But my gut tells me we're going to see the unemployment rate go higher. But I think that also falls along with your narrative that, well, I think we can't have it both ways. We're either in a growing economy, and that means long-term interest rates should be heading higher. or we're in a weakening economy and rates should be going low, which is good for your base case.
Yeah.
So I think it's hard to know which side of the coin we fall on, but either way, it's going to be interesting how the market reacts to it.
It is. And to your point, David, if the Fed is cutting rates this year or early on next year, that's probably not good.
No,
because we're seeing cracks in the system at that point.
Yeah.
And there is a lag to a lot of the data that the Fed is looking at, and data dependent. We've heard that for months on months, and talked about inflation for months on months. And owner's equivalent rent, for example, they're calling people to ask them what their rent
that's
is.
right.
That's how
exactly.
So the way they're calculating and how we're tracking the data, it's not exactly a perfect system.
For our listeners, if you don't know how the housing data is tracked in the CPI, they actually knock on people's door who are homeowners. So not that they're renting, who own their home, and then the Bureau of Labor Statistics asks them, if you were to rent your house out, what would you charge? That's how they get the rent data in CPI.
Most efficient way to do it.
Yeah, not exactly. Okay, let's talk about the economy just for a second. So if you just look at some key areas of the economy, housing sector we were just talking about, this is crazy. Mortgage loan applications are now at 30-year lows, down 30% year over year. So mortgage loan applications are at 30-year lows. New and existing home sales show significant year-over-year declines. Building permits are up minus 13% from a year earlier. Again, not great in a growing economy. Retail sales. That was a positive. Retail sales were higher in July by 0.7%. Huge upside surprise for retail sales. Is that not a sign of that the economy is expanding?
It is, but we're in this place, and I've heard this phrase uttered a lot, where good news is bad news for the market. Because even if the markets, even if the economy is growing and is strong, then that means the Fed is going to have to stay hawkish and be keeping an even closer eye on inflation, which is therefore a headwind to markets, not a tailwind. So there's a lot swirling around.
There is,
and going into this.
This is an interesting point. So the way that the Bureau of Labor Statistics does the data is they seasonally adjust data. And I won't put you to sleep on what that is, but retail sales were seasonally adjusted. If you take out the seasonally adjusted, actually retail sales were down negative 0.4% from June to July. This is on top of June's negative 2.7% monthly decline. So you had 2.7 decline, non-seasonally adjusted, negative 0.4% decline, non-seasonally adjusted. That's the weakest set of June and July retail sales data in 5 years. So again, you could argue that even retail sales aren't doing great.
Yeah.
So again,
that's a good job of putting it in perspective.
That's right.
Yeah.
So again, I still think you're right in that if we think we're heading towards a slowing economy, what does the Federal Reserve do to help stimulate a slowing economy? They lower rates.
Right.
If you lower rates, what does that mean for bonds? Bonds go up in value. The longer the duration of your bonds, meaning if you have 10-year bonds, 15-year bonds, 30-year bonds, interest rates go down. For every 1% drop in interest rates, it's equal to the duration of your bonds. So if interest rates go down 1% and you have an average 10-year maturity bonds, your bonds just appreciated 10% in value. So again, for our clients at Nicholas Wealth, or if you're with another advisor and you're thinking about what's the duration or what should the duration be in my fixed income portfolio, I think you're right. I think it's a good bet to bring the duration out on your fixed income portfolio. Try to lock in that 10-year rate now, and if rates go down, it could pay off pretty nicely.
Absolutely, and real quick on the mortgages, I think you said they're very low right now, or weakening in terms of mortgage applications.
Demand, lowest in 30 years.
But for those who are trying to sell their home, they're not having that hard of a time doing it. The supply demand and the
supply is just non-existent.
It's not there, so it's getting scooped up when it goes on the market.
That's right.
And a lot of folks refied and took advantage of having a lower interest rate and are going to pour into their homes.
We locked in 2.75% interest rate in September of 2021.
Like a lot of other people, yeah.
I mean, I'm never moving.
Yeah.
I mean,
no.
I'm
and that's
just not giving
60%
that
of the
up.
population,
Exactly.
or more.
Yeah. And a lot of our clients who are retirees that have refinanced that are like, David, I want to get a new home. I want to downsize, but I'm going to pay more for a home that's smaller, and my mortgage payment is going to be higher if I have a mortgage payment because rates are so high. So I don't think that goes on forever. We'll see. A lot, I think, is going to happen over the next coming months. This is why it's so important to watch what rates do. It's so important to watch where the interest rate environment ends up, because I think there's a lot that can happen over the next few months.
Absolutely. And I would just say the importance of having a bucket strategy, working with an advisor, and knowing the different vehicles, the entire landscape, what I can get on my income bucket, on my liquid bucket versus the stock market. I think it's important to know what that landscape looks like and choose our vehicles wisely.
Yeah, because if I can get 7% on my income bucket, that's fixed income with very little risk, why would I want to go out and take the risk of the market, given slowing economy, a lot of other factors that we discussed? It's why I think we may want to over allocate to fixed income at this point. You still need equities long term, but this may be a good time to over allocate to fixed income. Well, we appreciate you tuning in for another week here of the Retire Ready podcast. It was a good one, quick one, but it was a good one about fixed income. Obviously, if you have any questions, you can reach out to our firm, but we'd be honored to help. We just appreciate you tuning in and joining us each week for the Retire Ready podcast. I'm David Nicholas, Graham Reynolds. Thanks for being with us today. Have a blessed week, and we'll see you right back here soon for the Retire Ready podcast.